A series of taxation outcomes could potentially burden an older property owner $75,000 upon selling a residence they've possessed for many years. Not due to fraud, not due to concealment, stemming from one well-intentioned household choice most individuals haven't learned about. I'm familiar with a lady in Ohio who discovered this difficulty. She possessed her residence for 34 years. She transferred it last year, anticipating zero taxation liability. She'd resided there her entire mature life, nurtured her children there, completed payments years prior, an uncomplicated transfer, a new beginning. She was liable $23,400. And the choice that triggered it she executed at her dining table on a Tuesday midday, believing she was acting responsibly, believing she was safeguarding her household. It required her under 10 minutes. If you're above 60 and you possess a residence, April 15th represents the cutoff that decides whether you can address this discreetly or manage it the challenging way. And I intend that precisely as gravely as it appears. I'm planning to explain exactly what she executed and why it's relevant for you currently. But before I proceed into it, a brief comment. Everything I address today relies on present IRS regulations and federal taxation law, including legislative changes that may apply. Nothing in this content substitutes for guidance from a certified tax expert. Utilize it as a foundation, not a conclusive solution. Here's what this content addresses. For pitfalls, for entirely common property owner choices that are silently generating IRS complications for older adults currently. Then 3 elements that might genuinely return funds to your account on your 2025 filing that most individuals above 60 haven't discovered. Then a 7-step action outline, incorporating a complimentary resource on the IRS's actual website that reveals exactly what data they currently possess on your real estate. Most individuals only discover about the pitfalls. Very few discover about the funds they're abandoning on the surface. By the conclusion of this content, you'll understand both. Don't depart early. The 4 pitfalls form one word, home. H represents home equity errors. O represents ownership and title modifications. M represents move-out scheduling before a transfer. E represents extra earnings from the residence. Before we continue further, if this proves valuable today, please press the like button and distribute this with anyone in your circle who's above 60 and possesses a residence. That one distribution could rescue someone thousands of dollars. The individuals who require this most are typically the final ones to locate it. Now, let me complete her narrative. Her identity is Margaret. She's a fictional combination drawn from genuine situations tax experts observe routinely. Every individual I reference in this content is identical. Real outcomes, combination personalities. Margaret's spouse departed away several years ago. Her daughter Sarah contributed after that. Groceries, maintenance, physician visits, everything. One midday, Margaret's neighbor referenced that including Sarah to the title would create things simpler afterward. Prevent probate. Maintain the residence in the household. It appeared like practical wisdom. So Margaret executed it. County recorder's location. Basic form. No lawyer. No tax expert. No motivation to reconsider. Here's what nobody informed Margaret. When you convey partial possession of your residence to another individual, even your personal child, the IRS can categorize that as a taxable contribution. Depending on the worth conveyed, that may activate a documentation obligation on Form 709. And when the residence is ultimately transferred, the individual you included to the title may not meet criteria for the identical tax exemption you do because they never resided there as their principal dwelling. Margaret discovered 2 years afterward when her tax preparer examined her filing and stated 4 words she wasn't prepared to receive. We require to discuss. Every dollar of that charge was avoidable. The IRS doesn't care why you executed something. It only examines what you executed and whether it was recorded correctly. Good motivations don't appear anywhere on a tax filing. So, let's proceed into the home equity errors. Stay with me because this represents where most individuals' eyes glaze over. And that glazing over represents exactly what burdens them money. Most property owners believe that if funds originated from their residence, it must be linked to the residence for taxation purposes. That belief is incorrect. Full stop. A senior acquires $40,000 or $50,000 against their residence through a HELOC. They utilize it to assist a grandchild with education, address a medical crisis, or reduce debt. And because it originated from the residence, they believe the interest is removable. It's not unless the funds were utilized to purchase, construct, or substantially enhance the residence securing the loan. That's the regulation under the Tax Cuts and Jobs Act of 2017. If the funds went anywhere else, that interest is individual interest, not removable, and asserting it incorrectly generates a discrepancy that the IRS's computerized systems are progressively skilled at locating. Think back currently. Did you acquire a home equity loan or open a HELOC in the previous 3 years? Where did that money genuinely go? Into the residence or somewhere else? If it went somewhere else, you require a discussion with a CPA or enrolled representative before April 15th, because if that interest was managed incorrectly, there are measures available currently that become much more difficult after the cutoff passes. And the O pitfall is the one that triggers the most disagreements when I clarify it, because individuals receive it and instantly state that can't be accurate. That's just a household choice. I receive that every single occasion, and every occasion I state the identical thing back. That's precisely why it's so hazardous. A senior includes a mature child to the title for estate preparation, probate prevention, or just because that child has been assisting and it seems right. What seems like a household choice is also a taxation choice. And those two elements don't always desire the identical result. Think about the previous 5 years currently. Has anyone's identity been included to your real estate? A child, a grandchild, anyone? If yes, and no contribution tax filing was submitted that year, keep watching because this subsequent part is particularly for you. When you include someone to your title without them providing fair market worth, the IRS can categorize that as a taxable contribution. When the worth conveyed surpasses the yearly exemption threshold, a Form 709 contribution tax filing is generally obligated depending on the arrangement of the conveyance and your particular situation. If that was never submitted, that's a recording discrepancy sitting silently in your history. And when you ultimately transfer, the individual you included to the title may not meet criteria for the principal dwelling exemption, the regulation that permits most property owners to exempt up to $250,000 in capital profits or $500,000 for married couples because they never reside there. Their portion of the profit may be completely taxable. A transfer that should have been tax-exempt becomes partially taxable over a title modification that required 10 minutes. I've discussed with older adults who discovered about this at the settlement table, not before the transfer, not during the advertisement, at the settlement table. Documents already in front of them. That's when they received it. There's also the foundation issue. If you conveyed the residence entirely as a contribution rather than abandoning it as an inheritance, the recipient obtains your original acquisition price as their expense foundation, not today's worth. If you provided $80,000 and the residence is valued $380,000 today, they could be liable for capital profits taxation on $300,000 when they transfer. Had they inherited it instead, the foundation would reset to present market worth, and that profit would largely vanish for taxation purposes. One route burdens the household nothing. The other burdens them tens of thousands. The only distinction is the scheduling of the conveyance. Now that particular reason, April 15th matters more than individuals recognize. The IRS possesses a computerized system called the Automated Underreporter Program. It cross-references your tax filing against external data. Mortgage servicers, rental networks issuing 1,099K forms, and real estate-related documents. The discrepancy between what you documented and what the IRS can observe has been diminishing for years. Tax experts are observing more computerized notifications and more matching inconsistencies than at any moment in recent memory. After April 15th, if something hasn't been resolved, interest begins accumulating automatically. Penalties accumulate, and the Initial Occasion Penalty Reduction Program, a real recorded IRS policy that permits taxpayers with a clean adherence history to petition significant decrease or removal of certain penalties, becomes more difficult to utilize once evaluations are completed. The earlier you respond, the more alternatives you possess. Now, the move-out scheduling. This is the one that impacts older adults hardest, and it's the most confused regulation in residential taxation law. Under IRS Section 121, to exempt up to $250,000 in capital profits from your residence transfer, $500,000 if you're married submitting jointly, You must have resided in the residence as your principal dwelling for at least 2 of the 5 years instantly before the transfer. That's the 2 out of 5 regulation. Here's where it silently destroys individuals. Let me demonstrate exactly how this occurs. And as I proceed through this illustration, I desire you to envision your personal residence, your personal location, and think about where you've been residing for the previous 3 to 5 years. You relocate in with your mature children because of a wellness issue, or into a smaller location while your residence sits on the marketplace, or you begin leasing it out while you wait to transfer. All of these are reasonable choices. All of them influence your dwelling calculation. Say you relocated in with your daughter in January 2021. You maintained the residence, attempted to transfer, couldn't obtain the price, leased it for a year, and ultimately transferred in March 2026. You relocated out January 2021. Transfer completed March 2026. That's more than 5 years since you previously resided there. Under the 2 out of 5 regulation, you may not meet criteria for the exemption at all because both qualifying years fall outside the 5-year review window. If the residence gained $200,000, you could be liable for capital profits taxation on the complete amount. For most property owners in this earnings range, that's roughly $30,000. Not because you executed anything incorrect, because retirement situations and a taxation scheduling regulation collided in a way nobody cautioned you about. There are partial exemption provisions under Section 121C for wellness-related relocations. They're real, but they demand recording and don't apply automatically. And here's something I desire you to retain, because Dorothy's narrative in a few minutes demonstrates exactly what occurs when this pitfall combines with the subsequent one. If you've relocated out of a residence you still possess and intend to transfer, calculate the months this week. The window to resolve this exists currently, and now the extra earnings from the residence. This is the one individuals dismiss first because the amount seems small. That dismissal is exactly what creates it expensive. A senior leases out a spare room, maybe through a short-term rental network, maybe just to a college student, maybe a household member provides something modest to remain in the basement apartment. It addresses the utilities. It seems like a practical arrangement. But the moment your residence produces rental earnings, any amount, any arrangement, the IRS categorizes that portion differently. 3 elements change. First, that earnings must be documented on Schedule E. Informal arrangements aren't exempt. No formal lease doesn't mean nothing to document. Second, a portion of your residence expenses become potentially removable against that rental earnings. But without recording, you either face examination exposure or you overpay. Third, if you afterward transfer the residence, the rental portion may not meet criteria for the principal dwelling exemption. The profit gets distributed between residential and rental portions. The rental portion can be taxed as a capital profit, and depreciation recapture under Section 1250 taxed at up to 25% can apply to the rental portion even if you never asserted depreciation in the initial place. That spare room you leased for $600 a month for 2 years can influence the taxation treatment of your entire residence transfer. Not just that room, the whole operation. Now Dorothy. Dorothy is 68, Tennessee, resided in her residence for 27 years. In 2022, a wellness scare pushed her to relocate in with her son, Michael, temporary. She informed herself to address expenses while she waited to transfer. She leased the residence to a young couple, perhaps $1,100 a month. She didn't document it the initial year because her accountant had just retired and the software she utilized didn't ask the proper questions. The following year, Michael included his identity to the title just in case Dorothy's wellness got worse. No contribution tax filing submitted. Early 2025, Dorothy transfers, 27 years of possession. She proceeded into that settlement anticipating a clean, essentially tax-exempt transfer. The IRS decided she had relocated out more than 2 years before the transfer. The rental period had modified part of the residence's categorization. The title modification generated a contribution documentation discrepancy. The unreported rental earnings was a separate obligation underneath all of that. Dorothy was liable $23,400 across 3 separate issues, none of which she understood existed when she executed the choices that triggered them. She wasn't careless. She wasn't concealing anything. She was a 68-year-old lady managing a wellness crisis, a housing transition, and a household situation simultaneously without anyone informing her what she required to understand. Dorothy didn't fail the structure. The structure failed Dorothy, but the structure doesn't adjust itself based on that reality. That's the whole reason this content exists. I desire you to sit with that for just a second because what arrives next is genuinely distinct from everything we've addressed so far. And most individuals watching this are planning to wish they had understood it sooner. Now, the other aspect of this, because everything so far has been about complications, the subsequent few minutes are about funds you may be abandoning on the surface currently. Real funds verified by the IRS, available on your 2025 filing. The first is relatively new and most preparers aren't identifying it automatically. It's called the Senior Bonus Removal and it's part of recent tax legislation updates. If you're 65 or older, you may claim an additional $6,000 removal on top of whatever you already remove. Whether you specify or take the standard removal, it accumulates on top of both. Married with both spouses 65 or older, that's $12,000 total. Available for certain taxation years, phases out beginning at $75,000 modified adjusted gross earnings for single submitters and $150,000 for joint submitters. For many older adults in the zone, where 50 to 85% of Social Security is taxable, this removal pulls taxable earnings down enough to decrease that exposure. It won't remove Social Security taxation entirely, but it can meaningfully decrease it. For many older adults, that's $1,000 to $2,500 in real savings. This provision was concealed in lengthy legislation. Some taxation software hasn't been modified. Some preparers haven't caught up. Ask your preparer directly. Did you apply the senior bonus removal from recent legislation? If they look confused, locate someone who doesn't. The second is the SALT removal increase. From 2017 through 2024, the state and local taxation removal was restricted at $10,000. For property owners in New Jersey, New York, California, Connecticut, and Illinois, where real estate taxes alone often surpass $10,000, that restriction was painful. You provided the taxes. You obtained no removal for the surplus. As of 2025, that restriction is now $40,000. For 2026, it's $44,000, increasing 1% per year through 2029. The phase-out begins at $500,000 in modified adjusted gross earnings, well above where most retired property owners sit. Here's the complication. When the restriction dropped to $10,000 in 2017, millions of property owners switched to the standard removal and never reviewed. 8 years on autopilot, the restriction has quadrupled. Their patterns haven't changed. If your real estate taxes plus state earnings taxes surpass $10,000, execute the calculations again. Add your total SALT to your mortgage interest and charitable contributions. If that total surpasses the standard removal for your submission status, you should be specifying. If you currently submitted utilizing the standard removal when specifying would have rescued you more, you can modify within 3 years. Don't abandon that fund sitting there. The third is the energy credit. If you installed solar panels, a heat pump, battery storage, or other qualifying energy enhancements in 2025, the 30% federal residential clean energy credit may still be on your filing for that installation. Recent legislation modified this credit effective December 31st, 2025. Systems installed and operational by that date still qualify. Systems installed January 1st, 2026, or afterward may not. The IRS has verified the cutoff is based on when installation is finished and the system is positioned in service, not when you executed the contract or provided the deposit. If you possess a 2025 installation and haven't yet submitted, create sure that 30% credit is asserted. On a $30,000 system, that's $9,000 you don't desire to abandon behind for future upgrades in 2026 or beyond. That federal credit may be gone. Some states still possess their personal programs, but the 30% federal credit that millions calculated on may no longer be available for new installations. Now, this final one is distinct. It's not about your tax filing at all. It's not about something you executed incorrect. It's about funds departing your bank account every single year currently that you may be able to stop today with a 20-minute phone call. And there's one more element most older adults have never been informed about. This one has nothing to do with the IRS. It's a state and local real estate taxation benefit, and it differs by where you reside. But for many individuals watching this, it's valued more over time than anything else in this content. Almost every state in America provides a real estate taxation homestead exemption for older adults. These aren't small discounts. In Texas, the over 65 homestead exemption alone can decrease your residence's taxable worth by $60,000 or more on top of the standard homestead exemption, rescuing some property owners $4,000 to $6,000 every single year. Florida freezes your real estate taxation evaluation at the worth it was when you initially qualified. Meaning, even if your neighborhood doubles in worth, your real estate taxes don't go up. Georgia provides full exemptions from school taxes for qualifying older adults. New York, Pennsylvania, Ohio, Illinois. Almost every state possesses a version of this. Here's why this should create you genuinely frustrated. These exemptions aren't automatic. Nobody transmits you a letter when you turn 65 stating your taxes just went down. You must apply. You must go to your county assessor's location or appraisal district, complete out a form, demonstrate proof of age and dwelling. If you've been 65 or older for years and never applied, you've been overpaying. Some states permit retroactive applications going back 1 or 2 years, meaning you could obtain a refund on taxes currently provided. Call your county appraisal district this week. Ask what senior real estate taxation exemptions are available. Bring your identification and your title or a recent taxation statement. It requires about 20 minutes. And for many individuals watching this content currently, that call will rescue more funds over the subsequent 10 years than anything else addressed here today. Now, before the outline, 60 seconds on something that possesses nothing to do with taxes. It possesses to do with protecting yourself from individuals who will utilize everything you just received against you. Every taxation season, fraudsters target senior property owners aggressively. Phone calls, emails, individuals pretending to be IRS representatives stating you are liable for funds currently and will be detained if you don't provide by wire conveyance or contribution card. The real IRS doesn't call you demanding instant payment. The real IRS doesn't accept contribution cards or wire conveyances. The real IRS doesn't threaten detention over the phone. The real IRS communicates through official postal mail with a notification number in the upper right corner of every letter. If anyone contacts you asserting to be the IRS and generates urgency around instant payment, hang up, delete it. Report it to the IRS phishing hotline at phishing@irs.gov. The issues in this content are real. The individuals trying to exploit your concern about those issues are also real. Understand the distinction. Now, the action outline, 7 measures this week. Step 1. Retrieve your previous 3 years of taxation filings. Look at Schedule A for mortgage interest. Look for Schedule E, rental earnings resides there. Look for any 1099 linked to the real estate. Anything absent or unexpected, write it down. Step 2. Locate your title. County recorder's location can supply a copy online for a small fee. Check every identity listed. If an identity was included in the previous 5 years and no Form 709 was submitted, that requires expert review before April 15th. Step 3. Map your dwelling timeline. If you've relocated out of a residence you still possess, compute how many months since you previously resided there as your principal dwelling. If that number is at or past 24 months and you haven't transferred, obtain expert review before the transfer completes. Step 4. Check your IRS account transcript at irs.gov. Generate a complimentary account. 15 minutes. You'll observe every notification on file for your account and every piece of external data the IRS has matched to your Social Security number, incorporating 1,099K data from rental networks. If the IRS possesses data about your real estate that doesn't match your filing, you'll observe it there. Knowledge is the only element that provides you alternatives. Step 5. Track your home equity documents. Locate records for any HELOC or home equity loan. Write down exactly what those resources were utilized for. If they went into the residence, you likely possess a clean paper trail. If they went somewhere else, your filing may require review. Step 6. List every rental arrangement the real estate has possessed. Any amount, any arrangement, dates, and amounts. A taxation expert can inform you what was managed correctly and what requires to be resolved. Step 7. Contact a CPA or enrolled representative this week if you possess any uncertainty after measures 1 through 6. The National Association of Enrolled Agents possesses a complimentary directory at NAA.org. Search by location and specialty. When you call, ask particularly whether they possess experience with IRS penalty reduction for real estate issues. That one question informs you instantly if they're the proper individual. Dorothy executed none of these 7 elements. Not because she was careless, because nobody provided her this list before she required it. You possess it currently. Utilize it. The burden of an expert review is almost always smaller than the burden of the complication it was supposed to prevent. Let's bring it all together one final occasion. The 4 home pitfalls. H. Home equity. Funds from your residence isn't automatically housed under IRS regulations. O. Possession modifications. Including someone to your title is a taxation event whether you intended it to be or not. Move-out scheduling. The 2 out of 5 regulation doesn't pause for retirement or wellness transitions. E. Extra earnings. Rental earnings from your residence modifies its taxation categorization, and that modification follows the real estate all the way to the transfer. The 4 elements working in your favor currently. The $6,000 senior bonus removal available on your 2025 filing. The SALT restriction at $40,000 if you're in a high taxation state and still on standard removal autopilot. Execute the calculations again. The 30% energy credit for 2025 installations that haven't yet been submitted, and the senior real estate taxation homestead exemption sitting unclaimed at your county appraisal district that could rescue you thousands every year. If even one of the 4 pitfalls appears familiar, don't submit this away as something to think about afterward. That's exactly how Margaret concluded up receiving those 4 words. That's exactly how Dorothy concluded up being liable for $23,400 on a transfer she anticipated to be clean. Begin with step 1 tonight. The cutoff is April 15th. By then, what could have been a silent remedy becomes a scramble, and scrambles are expensive. If this content assisted you, press the like button currently. Subscribe if you're not currently here. Distribute it with anyone above 60 who possesses a residence, and drop a comment below. Which one of these did you not understand about before watching? That question genuinely assists me decide what to address next, and your response might be the topic of the subsequent content. In the subsequent content, I'm planning to proceed through Form 709, the contribution taxation filing that most older adults never submitted when they modified their title, and demonstrate you exactly how to resolve that discrepancy before it becomes a formal IRS notification. If Margaret's situation appeared familiar when I informed her narrative at the beginning of this content, that subsequent content is particularly for you. It's currently on your screen. Watch it now because this is exactly the kind of topic where waiting burdens you more than responding.